Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know. First, Delaware Supreme Court restores Elon Musk's $56 billion Tesla pay package, setting a major precedent for founder-led tech companies. We'll analyse why this stunning legal reversal is a turning point and how it could affect corporate governance and the Dexit trend. Second, Lucid Motors loses $338,000 per car, despite its world-beating EV technology, raising questions about its survival against Tesla. We'll explore how this cash burn paradox could transform its product roadmap and what it means for its reliance on Saudi funding. Third, Google's new Imperceptible SynthID watermark aims to detect its own AI videos, creating a potential trustworthy walled garden against deepfakes. In this episode, we'll break down this proprietary approach and what it signals for the brewing standards war against OpenSea 2PA systems. Fourth, Verizon's $20 billion deal highlights a new M&A playbook where dropping DEI policies is key to securing fast regulatory approval. So we'll discuss why this political pivot matters for Wall Street and what it means for market competition and systemic financial risk. Fifth Valve's entry-level $399 Steam Deck is discontinued as the AI industry's demand for memory components drives up consumer hardware prices. Today we'll take a closer look at this supply chain collision and its implications for the future of affordable PC gaming hardware. The story begins with a decision that caught everyone by surprise. The Delaware Supreme Court just handed Elon Musk his record-shattering $56 billion Tesla pay package back. This is a massive reversal, overturning a lower court that had completely cancelled the historic deal. But this is far from a total victory for Musk. The situation is actually much more complicated. This isn't just about the dollar amount. Musk's compensation is a radical all-or-nothing model tied to hitting astronomical market cap and operational goals. That's a world away from the pay for CEOs at, say, Apple or Google, who get a more traditional mix of salary, bonus, and stock. Musk's deal was a high-risk, high-reward moonshot, and that's a key reason it's been so controversial from the start. But what really brought this to a head was the next development. The Supreme Court did not reverse the lower court's most explosive findings. The original ruling that Musk was a controlling shareholder and that the pay plan was unfair and improperly granted, that all stands. Now, that controlling shareholder part is a legal bombshell. Under Delaware law, control isn't just about owning more than 50% of the company. A founder can be deemed a controller based on their immense influence and authority alone, even with a minority of the stock. This ruling sets a major precedent for other powerful, visionary founders, suggesting their influence comes with a higher level of legal responsibility. So why is the money being restored? The higher court ruled that completely cancelling the entire plan was simply too extreme a remedy. For the plaintiff who sued, the court awarded just $1 in nominal damages. This highlights a fascinating legal principle. The court wasn't saying the process was fair. Instead, it was focused on the penalty. The judiciary has discretion, and in this case, they decided that a complete cancellation or rescission of the deal was a disproportionate punishment for the flawed process. The remedy, in their view, didn't fit the crime. This decision likely ends a years-long legal war over the unprecedented 2018 compensation plan, a plan that, when granted, made Musk the wealthiest individual in the world. This was the same case that prompted Musk to move Tesla's site of incorporation out of Delaware and publicly bash the original judge. And that move out of Delaware is a much bigger story than just one CEO being angry. It has sparked a trend. Some are calling Dexit. Other major companies are now reevaluating where they are incorporated. States like Texas are actively courting them by creating new specialized business courts and offering zero corporate income tax. What started as a personal battle for Musk may be igniting a systemic shift, threatening Delaware's long-held dominance in the world of corporate law. A Columbia Law School professor confirms the nuance here, stating that while the pay plan is restored, the court's decision that the Tesla board and Musk arranged an unfair deal was left completely intact. Even the lawyers for the shareholder who sued are standing by their fight, releasing a statement that they are proud to have participated in a verdict, calling to account the Tesla board and its largest stockholder for their breaches of fiduciary duty. So, to sum it all up, Elon Musk gets his $56 billion restored in a stunning legal comeback, but the official court record from a ruling that was never overturned still describes the process that led to the deal as deeply flawed. Speaking of high-stakes moves in the EV world, Elon Musk isn't the only one facing immense pressure. Over at Lucid Motors, they just posted a net loss of close to $1 billion in a single quarter. To give you some perspective, at one point, the company was losing an estimated $338,000 for every single car it sold. That's not a typo. They were losing more than the price of the car itself on each vehicle that rolled off the line. The numbers were so bad, one RBC capital markets analyst is publicly asking the question on everyone's mind, how long can the company keep losing cash? This is the central paradox of Lucid. The company gets rave reviews and has world-beating technology. Its Air sedan boasts a 512-mile range, a number no other EV can touch. Lucid's technological advantage actually comes from its vertically integrated approach. They design almost everything in-house, the motors, the batteries, the software. This gives them incredible control and allows them to achieve efficiencies other automakers can only dream of, like getting over 5 miles per kilowatt hour. However, that same vertical integration is also incredibly expensive and complex to scale up. It's a huge reason why they've struggled with mass manufacturing. The core issue, though, is that it's a sedan in a world dominated by SUVs. An expert from telemetry called it a fantastic car that came to market at kind of the wrong time. The numbers prove it. Last year, Lucid delivered just over 10,000 vehicles. For perspective, Tesla delivered 1.8 million. Now, everything is riding on the company's new 3-row Gravity SUV, but the launch has been plagued by supply chain shortages for key materials. Lucid's own interim CEO, Mark Winterhoff, admitted on an earnings call, "We haven't been able to produce as many as we wanted up until this point." So who is bankrolling these massive losses? The Saudi Public Investment Fund, which owns about 55% of the company. And this isn't just a simple investment, it's a strategic move tied to Saudi Arabia's Vision 2030 plan to diversify its entire economy away from oil. They're not just buying shares, they're investing in a future where they are a major player in the electric vehicle market. In fact, they've already helped build Lucid's first international factory right there in Saudi Arabia. This deep reliance is a double-edged sword. While it provides a massive financial lifeline, it also ties Lucid's fate directly to the political and economic goals of a single state-backed entity. They've poured in billions, but one analyst warns it's unclear how long they will continue to be patient. If that was just the appetizer, the main course is just being served. Lucid is already planning its next vehicle, a mid-size SUV, to compete directly with the top-selling Tesla Model Y. This is where some experts are raising a major red flag. When we place Lucid's do-it-all approach alongside a competitor like Rivian, which is laser-focused on the adventure lifestyle market, the contradiction becomes clear. By trying to be everything to everyone, Lucid might be spreading its limited cash and engineering talent way too thin. This raises a critical question. If Lucid is losing money on cars selling for over $100,000, what will its profits look like when it's selling a vehicle for half that price? Lucid is betting that its hyper-efficient technology, which squeezes more range out of smaller batteries, will be its saving grace. The company has a clear plan to profitability, but it's in a race against its own staggering cash burn. We were just talking about Lucid's reliance on unique in-house technology. Now, let's shift to the software world, where Google is taking a similarly proprietary approach to a very different problem, deepfakes. The company just made a bold claim. It can spot its own AI-generated videos using a watermark it calls Imperceptible. Unlike older watermarks that you could see or that degraded the image quality, SynthID embeds the watermark directly into the content's data. Think of it like weaving a secret thread into the very fabric of the video. We previously walked through why metadata-based labels can get stripped by a simple upload or screenshot. Google's twist is an invisible mark inside the pixels and audio itself. It's designed to survive common edits like cropping, filtering, and even compression, which is how previous watermarks were so easily defeated. This move comes after competitors like OpenAI saw their own watermarks get easily scrubbed from viral AI videos. Now, Google is firing back with its own detector built directly into the Gemini app. A few weeks ago, we flagged how tools like Sora could lose their labels in the wild. This is Google trying to cover that gap, at least for its own ecosystem. This is part of a high-stakes technical cat and mouse game. As soon as one company creates a watermark, There's a whole community online dedicated to building tools to remove it. We also warned about the implied truth effect and noted Google's move to sign images on Pixel phones. This feels like the video counterpart to that play. Google is hoping that by baking this watermark into the fundamental data of the video, it's made it much, much harder to scrub clean. The technology is called SynthID, and it scans a video's visuals and audio for a proprietary digital signature. It doesn't just give a simple yes or no answer. It provides specific timestamps showing you exactly where the AI footprint was detected. In other words, it leans toward the invisible forensic watermarking approach we discussed before, rather than the metadata-based provenance that platforms sometimes strip away. This is Google's high-tech answer to the deepfake crisis, one that's getting worse as tools like Sora and Veo mimic even low-res CCTV footage. Now, get this. The tool only works on content made with Google's AI. This raises a huge strategic question. Is Google just taking a first step towards safety, or is it building what some call a trustworthy walled garden? By making its own content verifiable, it creates an incentive for creators to use Google's tools over competitors like OpenAI or Midjourney, positioning Google as the safe and trusted choice. Believe it or not, the central conflict isn't just about one company's clever watermark. The report highlights that OpenAI's Sora watermarks were easily removed, and there's a critical lack of coordinated tagging of AI content across social media platforms. We previously noted that C2PA style metadata can vanish when content gets reposted. This fragmentation is exactly why deepfakes slip through. And remember, the human cost is real. Creators have already told us seeing deepfakes of themselves hawking bogus products is terrifying. And once a model learns your likeness, unlearning it is notoriously hard and expensive. And this creates a dangerous psychological trap for all of us, the not made by Google blind spot. If a video gets checked and comes back without a Google watermark, our brains might jump to the conclusion that it's real. Continuing our earlier warning about the implied truth effect, all it really means is that it wasn't made with Google's AI. It could absolutely still be a deepfake from another source. This could actually make us less critical of the content we see, not more. Even Google's own leaders have cautioned against blindly trusting AI outputs. Take that mindset with you here. So while Google is calling its watermark imperceptible, the real question is for how long? We don't yet know how resilient SynthID truly is against those who want to remove it, or if other platforms will even adopt the technology to detect it. This is where the situation takes a more complex turn, because there's a standards war brewing. On one side, you have proprietary systems like Google's SynthID. On the other, you have an open cross-industry standard called C2PA, which stands for the Coalition for Content Provenance and Authenticity. This is an alliance of companies, including Adobe and Microsoft, trying to build a universal chain of trust that works for everyone. We've talked about a key C2PA weakness signatures living in metadata that can be stripped. Google's approach tries to dodge that by embedding signals into the media itself, but it's still a closed system. This all points to the core of the problem. Google has developed a sophisticated tool to police its own creations, but it's a targeted solution in a landscape facing a massive systemic issue. Until the big platforms and hardware makers align, we risk what we called an authenticity tax, where well-funded organizations can prove provenance and everyone else can't. And this is where governments are starting to step in. The European Union's AI Act, for example, is already mandating transparency and clear labeling for AI-generated content. A while back, we examined how the EU's long-running clashes with big tech, seen by some as necessary guardrails and by others as regulatory protectionism, make the stakes here geopolitical, not just technical. These new laws might eventually require platforms to be able to detect deepfakes from all major sources, not just their own. If that happens, a proprietary tool like Google's, while impressive, simply won't be enough. Google has built a new lock for its own door, but the real challenge is that across the internet, most doors are still wide open. Speaking of high-stakes corporate strategy, a new playbook is emerging on Wall Street, and it's turning the world of mergers and acquisitions upside down. Let's start with a single fact that might just change your entire perspective. Verizon ended its diversity and inclusion policies to push through a $20 billion acquisition. And they aren't the only ones. The merger of Paramount Skydance was approved only after it also ended its DEI programs. And get this, after Paramount paid $16 million to Donald Trump to settle a lawsuit. This isn't a coincidence. It's a strategic pivot. We're seeing the M&A approval process shift from a traditional rules-based system to one that's heavily influenced by political factors. So the thing is, regulatory bodies like the FCC have begun factoring corporate diversity, equity, and inclusion policies into their evaluations. To get deals across the finish line, companies are feeling the pressure to align with the administration's stance. It's a massive trend, with firms like Goldman Sachs also ending policies that require diversity on the boards of companies they took public. This is the new playbook for getting deals done. Wall Street expected a simple M&A boom under the Trump administration. What they got was a roller coaster. On the surface, the numbers look huge. Deal value soared to $2.4 trillion, fueled by mega deals like Union Pacific's $85 billion bid for Norfolk Southern and Netflix's $72 billion play for Warner Brothers Discovery assets. However, if you zoom out, you'll see another layer to this story. Underneath those headlines, the market was actually shrinking. This creates what experts are calling the mega deal mirage. While a few massive companies are consolidating and driving up the total dollar value, the actual number of deals is falling. The number of deals under $250 million, for example, has seen a steady decline. This decision brings both the benefit of large-scale consolidation and the inherent risk of less competition and innovation, because the mid-market, where so much growth happens, is getting squeezed out. The total number of deals fell, with sectors like automotive getting hammered by tariff uncertainty. Ford took a staggering $19.5 billion write-down after reversing its plans for electric vehicles. For the first half of the year, a KPMG partner said the uncertainty put a big pause on M&A in general. Then the script flipped entirely. In the second half of the year, deal-making exploded. According to one top banker, the time it takes to get a deal approved has been cut in half. He stated, "I've never seen anything like it," adding, "Deals are getting approved at record speed, and the types of deals getting approved now would never have gotten approval under the last administration." And it's not just a general speed up, it's a targeted frenzy in specific sectors. This signals a potential unwinding of regulations put in place after the 2008 financial crisis. This has set off a frenzy, especially in banking, where the number of deals surged 88%. Interestingly enough, this is being driven by activist investors who see a golden opportunity. For instance, one hedge fund successfully pushed for the $10.9 billion sale of Comerica, a major regional bank. Now they're targeting others, creating a wave of consolidation. The big question this raises is about systemic risk. Are we allowing banks to merge so quickly that we're creating institutions that are too big to fail all over again? Now, everyone is scrambling. As one analyst put it, the window for deal making is wide open, and it feels like everyone is looking at their options right now. That chaotic market we were just discussing is having ripple effects everywhere, including in the world of PC gaming. The price to get your hands on a brand new Steam Deck just jumped by over $150. Valve has quietly pulled the plug on its most affordable model. The entry-level $399 LCD Steam Deck is officially gone. It's sold out in the US, and according to Valve's own website, it is not coming back. This means the new price of entry is the $549 OLED model, a massive leap for anyone looking to get into the handheld PC gaming scene. Now, for a long time, the gaming industry has run on what's called the razor and blades model. You sell the console, the razor, at a low price, sometimes even at a loss, to get it into people's hands. Then you make your real money selling the games, the blades. Sony and Microsoft have done this for years. So when Valve came in with an affordable PC handheld, everyone assumed they were playing the same game. But this recent move challenges that whole idea. On the Steam Deck site, the company posted a definitive note. We are no longer producing the Steam Deck LCD 256GB model. Once sold out, it will no longer be available, and now it's gone. So what's really going on here? Valve hasn't released an official explanation, leaving everyone to speculate, but that's not the whole picture. The real turning point points to a new force impacting your wallet, the AI boom. Experts suggest that surging demand for RAM and storage, driven by the artificial intelligence industry, has made it nearly impossible to continue offering a powerful handheld at that $400 price point. The components are simply getting too expensive. After all, the AI industry and the gaming industry are now fighting over the same basic ingredients. The AI world needs something called high bandwidth memory, or HBM, for its powerful servers. Making that high-end HBM uses 3 times the manufacturing resources as making the regular memory that goes into a device like the Steam Deck. So memory makers are shifting their production lines to chase the massive profits in AI. In fact, TrendForce reports that by the end of 2024, the DRAM industry is expected to allocate around 14% of its total capacity just to producing HBM. And this isn't a temporary blip. It's a long-term shift. The AI boom is literally eating the supply chain for consumer electronics, and your wallet is feeling the bite. And if you think a competitor will just swoop in to fill the gap, think again. The PC gaming handheld market is more crowded than ever with players like Lenovo and Asus, but it's hard to see any of them filling that crucial entry-level void left by Valve. From a strategy perspective, Valve is sending a signal they may no longer be trying to be a Nintendo Switch killer for the mass market. The data actually supports this. The average Switch user is very different from the average Steam Deck user. Instead, Valve seems to be doubling down on its core audience, dedicated PC gamers who see the Deck as a premium, portable extension of their existing Steam library and are willing to pay for it. The message is clear. While the market for high-end handhelds is exploding, the era of the sub-$400 Steam Deck is officially over, fundamentally changing the landscape for new players wanting to get in the game.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.